Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major Real Estate Podcast. My name is Nathan Sosa, and I'm joined by my co-host, Matt Hamilton. Matt, what did you do your 4th of July? Do you have any traditions or anything that you generally do?
Yeah, so last busy season, I told myself I'd give myself a little tax season gift, and I bought a Pit Boss pellet smoker. So for the last 2 years on the 4th of July, I've just smoked some pulled pork for the family. Swam in the pool. Good time. No complaint.
Okay, so that's planned this year?
Yeah. Same this year, same as last year, probably same for the foreseeable future. So
going forward, yeah. And so I guess it's really important because you will have it's not the first grandkid in your family, is it?
Yeah. No, so yes and no. So my wife and I are expecting our first kid here in the next couple of weeks, or it's 4 to 6. God, that number keeps getting a lot smaller. A lot faster. But yeah, no, so on my side, it's my parents' first grandkid, and then Jessica's sister has a few kids, so it's yes and no to answer your question.
Yeah, well, everybody will be coming to your house then for sure, because you both have the meat and the grandbaby, so we're going to be coming your way.
No reason not to come over. Makes my life easier.
Yeah, I love 4th of July. It's like, not just because it's not amazing from a patriotic sense, always a great time to reflect on history and things that have been done well, and also things that we can do better as a nation. But to me, it's like Christmas, except there's no presents and there's no required schedule, right? It's just like, I'm going to throw something on the grill at 3 o'clock. You can come, you can not come. We're going to be in the pool at this time. You can join, you can not join, or we're doing this at that time. So it's always like, hey, it's a great time to get together with family and friends. Everyone's trying to do stuff together, but there's none of the social requirements, like you have to be here for Christmas because we open presents at XYZ time, so there's no stress from that, there's no planning, it's just kind of chill. Some people probably have a little way more stressful 4th of July's and have a lot more tradition and whatnot. With my family, it's just we're just going to chill by the pool and hang out, and that's that.
Yeah, no, it's a very relaxing holiday in that way. The hustle and bustle of November and December is always very, it's great. It's very chaotic though. Are you a fireworks guy? You get fireworks?
So once upon a time, I used to be a fireworks guy. I still kind of am. I'm no longer allowed to because I almost blew myself up one year.
Dude.
Quite literally, some friends and I decided to stick 3 launchers right into each other and see what would happen. And of course, you don't time them up appropriately because there's milliseconds difference no matter what you do. And so one of them shot and then pointed the other one directly towards me. And so I jumped in the air at the last second, and the firework literally went underneath my feet and blew up about 10 feet in front of me. So I am no longer allowed to do fireworks for that reason.
Wow, that's a tale for sure. I have never really been a firework guy because I am very paranoid that I'm going to lose a finger. So I am have the longest lighter possible and just kind of light it and run away. So there was also a time when a couple years ago, we were living in downtown St. Louis. I had an apartment there, and 4th of July was always fun to look out of our window and see a ton of fireworks across the city, and that was fun. But what was more fun were the people in the parking lot behind our building who were just shooting Roman candles at each other, and they almost caught an entire parking garage on fire. So that was a spectacle. But yeah, all kinds of fun shenanigans.
I hope you have that on video because that's pretty amazing. Speaking of assets under disrepair potentially.
Nice segue.
Today's topic is partial asset disposition. And I feel like many of you probably are okay, I'm tuning out now. Maybe you tuned in after you found out that I almost blew up a couple of years ago. And then you're tuning out now. We're talking about asset disposition. Sounds very accountant-y. Don't worry, we'll call it PADs going forward. But there's actually, PADs are a fantastic hack in real estate or just other businesses in general. Matt, you should tell how this actually helped one of your clients this year real quick. And then that way we can then talk about how they actually work and the practicalities to them.
Yeah, no, we can definitely talk about that. You were saying we'll call them pads to make it sound more fun. And then in my head, it immediately went to a fictional pad man. It's like Pac-Man, but he disposes of partially Anyway, bad joke. But yeah, so at a really high level, what a PAD is, or a partial asset disposition, is if you acquire a property, you place the whole property in service. Usually you're doing a cost seg, and we're splitting that asset into all of its components. And a very simple example is the roof is one of those components. But what if 2 years later you have to replace the roof? Well, now the roof that you placed in service initially when you bought the property no longer exists. Mm-hmm. So what do we do with it? Well, you can write off the original roof and then capitalize the new roof, because you have to capitalize the new roof anyways. So you want to make sure that you're writing off the remaining cost of the original roof so that you're not depreciating two roofs at one time. So that's just really simple, what a partial asset disposition is. And just as a really quick example, I have one client, lots of commercial properties, and he has tons of tenant improvements for each tenant that moves into these properties. And over the course of years, there's lots of assets that just kind of get lost in the shuffle. And these properties have been in service for at least a decade, a lot of them, right? So there's a lot of property that gets missed in the shuffle and never disposed of. So we went through the exercise of going through each depreciation schedule, figuring out which assets are no longer in service. And we did a partial asset disposition to catch everything up to be true to what was actually in service at the end of the year. And across his entire portfolio, he was able to offset at least 80% of his tax liability for 2024 with just the losses that were allocated to him from these partial asset dispositions. It was a huge win for the client. And it's really something very simple and just a very kind of check the box accountant style thing to keep track of, but it has a huge impact on you as a real estate operator.
Yeah, absolutely. It's crazy. It's like, I think it was like close to like $1 million of deductions that were created just for that single person. So it's not including the rest of the LPs that are involved in this, right? That's just for one individual. That's almost $1 million, which is crazy to think about. It's like, hold on. It's like, just remember, like, this is the number one thing that I have seen missed from large syndications to just the smallest real estate investor. I know, like, that's not who we're talking about, but across the board, it's a massive thing that should be viewed. So basically, if you have a renovation or a repair, and on the depreciation schedule, you don't see when you install the new improvement, whatever it might be, if you don't see a matching disposition on that depreciation report, that means that a deduction was missed in this case. And so, look, accountants are busy. We have lots of things going on, lots of things we're trying to figure out. So give us a little bit of grace if you catch that. But that's just an item that can be found and can help out with your losses there. So it's really, really strategic and be really, really helpful, honestly. So how do we identify those components? How do we figure those out? And like, what tools do people have to help them look for these partial, or even figure out how much should I write off from this?
So there's two scenarios. There's the proactive approach, which I highly recommend to everybody so that you stay on top of this year over year. And then the other scenario is, well, I haven't been keeping track of this forever, and these properties have been in service, so how do we figure that out there? So there's two different scenarios. But all of this really comes down to diligent bookkeeping and record keeping. It's really that simple. It's not a sexy answer. It's not super fun, but just basic accounting, right? If you have a bookkeeper or an accounting team that's tracking this over time, whenever you, let's say, replace the HVAC in a property or something like that, what's going to happen is your accounting team is going to capitalize the new cost of that HVAC unit and add it to the basis of the property. And generally speaking, the other side of that process is they need to be eliminating the original HVAC unit that was already on the property. And if that's something that, if you're aware of, you can make your accounting team aware of it. And it's just something that you have to consistently bring up. And I know it's very easy to say, well, they're my accountant. They should have it all figured out. Like Nathan said, people make mistakes. No one's perfect. So it's just really important that when you're reviewing your financials or your tax return or whatever it is, you just make sure that you vocalize and say, hey, I did a major renovation. I replaced the roof, the windows, the HVAC unit, the plumbing, whatever it is. Just make sure you say, I did this. Did we dispose of the original asset that was replaced in that process? And just make sure that everyone's doing that. The more you bring that up and the more you have that conversation with your CPA and your accounting team on a regular basis, the less likely this is to be missed month over month, year over year, however often you're kind of reviewing this process.
Totally. It's the small things, right? It's always the small things in life that help us create big wins. And so a lot of people are like, well, I want to do the big items, right? Well, sometimes we only do the big items once or twice, right? We can only cost like a property twice, which that's also how we figure out how the partial asset disposition works. And so like from a technical perspective, that like when you purchase a property, right, for let's just say $1 million in this instance, purchase $1 million property, et cetera. So you got like, it doesn't tell you what the value of your roof is. And so how do I figure out the value of my roof, the value of my HVAC system? How do I figure those pieces out? And the ultimate answer is you figure that out by a lot of times through a cost segregation study, because they will assign those values and split all those costs out with the cost segregation study. So that's generally going to be how you backlink to that and figure out what do I write off or dispose of, generally speaking. Now, sometimes we do have people who have never done a cost seg before, and they're like, well, I've done partial asset dispositions. How do I figure that out? It's called producer pricing index. It's another opportunity you do. Basically, you just go back and using inflation and other calculations and go back to figure out what that original cost was once it was purchased and placed in service, and then using that to figure out that number. Cost segs are always way easier. I'm sure Matt would agree. Is that like, hey, from the compliance side, if you have a cost seg, it's going to be way more helpful in this instance to figure out what to dispose of when you do the capitalization.
Yeah, 100%. Especially if you are a larger real estate operator and you're buying commercial property, multifamily, these larger pieces of real estate, there is almost no scenario where it doesn't make sense to just get a cost seg done for every single property. So this is something that you should probably already have on hand whenever you do the partial asset disposition. That's always the easier route. But like you said, Nathan, there's ways around it if you don't have a cost seg, but you should.
Yeah, it's just easier, right? It's just way easier.
Yeah, way easier.
Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. So unfortunately, this is where we get to a dichotomy, right? Partial asset dispositions work fantastically for residential owners and commercial owners, right? And so remember, like, just because commercial and residential, the main difference is the fact is like one provides people places to live, the other is like it doesn't, right? That's ultimately what it is. Like wherever people don't live falls into the bucket of 39-year property. And on that note, 39-year property does have advantages, even though they have worse depreciation life. The advantages they get is they get to use 179 deductions, actually. They get to use immediate expensing. And what falls into that bucket, oddly enough, is roofs and HVAC systems. Those opportunities fall into this bucket here. So in a year, you do a partial asset disposition, but replace the roof simultaneously, you almost get the double dip, right? So normally a roof is a 39-year asset that you actually don't get to utilize. Now, there's a lot of caveats to 179, and maybe we should have a 179 discussion all on its own one day. But essentially, you only deduct up to income. So if you're looking to produce tons of losses, probably not the best way to go, unless you just want to go ahead and utilize that now. But it's just another opportunity where maybe you can potentially double dip depending on your situation here. But it's just another opportunity here. Matt, how does this show up on a tax return? Other than the depreciation schedule, is there a specific form or something like that that's used there?
Yeah, so it's actually the exact same form that you would use if you sell any business property, because the way the IRS sort of treats these partial asset dispositions is they treat it as the sale of business property with sales proceeds of zero. So it's going to show up on Form 4797 where you're just selling the property. And very simply, you're just kind of selling it $0 of proceeds, whatever dollars of basis. So that basis, the entire basis is the loss. And the basis would be equal to what you capitalized it at minus any depreciation that was taken. So you're basically just writing off the remaining undepreciated value of that asset. So just very simply, as how it's treated, and it's where it shows up on the return.
Yeah. So be on the lookout for those forms. Like, I know it's a little bit in the bullets, but it's just like some things like, hey, I'm sure you all have checklists that you've created with your accountant that you like to mentally look through to ensure is like, okay, was this taken care of? Was that taken care of? Right. Our clients do that too with us, and like, it's totally acceptable. We want you guys to be involved in the process. I understand, because guess what? we might not have known that you did a roof replacement, right? Sometimes all these costs get lumped together depending on how the accounting's done. And so it's not the fact that you didn't know and that we didn't know. Sometimes it's just like a break in communication in a lot of instances. And so like saying, hey, this should be here. It's like, oh, wow. Okay, we didn't know that. So we can make sure we can get that on the return now. And then what's great about that is that this is just a small way that you can really help with your savings, right? Like in our example at the beginning of the show where you lose your saving basically in $700,000 in deductions, which turns into like $250,000 of tax savings, depending on whatever your tax rate is, right? That's a massive boost and an insane rate of return if you think about it from that perspective. And hey, we're all here trying to do our own version of wealth building, and that's mailbox money almost, is the way I would try and describe that.
Yeah, I would say it is the tax equivalent of mailbox money because it happens regardless of whether or not you captured on the return or not. You just need to make sure you have a system in place of catching it and making sure you're having those conversations. It costs you nothing. It just costs you a little bit of your time and having a little bit of know-how to just be aware of it and to look for it. It's a way to unlock a lot of passive tax savings without having to do any crazy strategies to try to avoid it.
100%. Now, just FYI, there are some caveats to this. So technically, you got to make an election to do this. And it has to be done on the return in the year you dispose of the property. So that's why it's probably good at the end of each year to go through with your CPA or accountant to figure this out and look through and say, okay, this is no longer here, that's no longer here. So you can claim those deductions. If you miss it, it's not the end of the world. We can still claim it and fix it with what's called an accounting method change, basically. So then you just basically recapture it in the next year. That's totally possible to do, and that's very doable on a form like that. It's a little like it's an extra step we have to deal with now, but still not the end of the world here. Again, so just like I want to like just recover a couple items is that you can do this on roofs, you can do this on HVACs. I want to say another thing too, especially on HVACs for really large commercial properties or even residential properties. One item to really think about is the fact, look, if you've got 4 units, let's say you got 4 large massive HC units and you have to fully replace one of them, correct? So you got to fully replace one of them and okay, great. Now you do a partial asset disposition, but since normally we have to capitalize items like that, and that's where we can think about using 179, but let's say this is a multifamily property, so we don't have the ability to use 179 and write that off in the year we place in service. So then instead, what we look at is using the repair regulations from 2014, which is where partial asset dispositions came from. And actually, since that's only 25% of the overall HVAC unit, like component, right, since we've got 4 large units operating the property, we can expense that, right? So that's a major advantage. And I'm sure we'll have another show on that, talking about how you can utilize that. Because it's another small way that large operators can get wins along the process is by doing these kinds of things, right? It doesn't sound as cool as deficit restoration obligations. It doesn't sound as cool as profits interest, which we haven't had a chance to talk about yet. It's not as cool or as sexy even, because those items are sexy and cool and they're talked about in Congress all the time, right? But these items are just small wins that we get through tax and accounting methods that we can keep building on and can really build wealth, in my opinion.
Yeah, absolutely. And kind of touching on the commercial side of this as well, just one quick tip for anyone operating commercial property. One really easy way to help track partial asset dispositions is to let your accountant know which tenant any tenant improvements are related to. So if you're capitalizing a bunch of assets related to a tenant that's moving into the building, even if it's the entire building, just make sure you say, we did these improvements because of this tenant. So that way later on, if that tenant leaves, you can look at the depreciation schedule and say like, well, the assets that are associated with tenant A can all be disposed of because they don't exist anymore. Now tenant B is in the property and we have new assets attributable to tenant B. So it creates a very systematic way of just very easily being able to eyeball what assets are no longer in service in a commercial property if they are tenant improvements. So that's just another thing to be aware of that I've seen work really well for some of our clients.
Absolutely. No, that's a great point, Matt. One thing I want to mention too, if you have any interest, check the show note links. We have a partial asset disposition guide for you guys to read, right? It's got a little bit more of the nitty gritty and talks about how you can do this and how it's been done. So really going to be helpful for you and honestly can be a helpful checklist for a tax preparer. And also today's episode is a little bit shorter. So I'm sure many of our listeners have been curious about what's going on. Like when do they talk about the tax bill? When are they going to talk about the one big, beautiful bill? I'm sure they've been asking questions on that. So I'll ask you, do you have any current questions on the bill yourself? Or what questions have your clients been asking as of late?
Well, right off the bat, one burning question that I have, not necessarily for my clients, It's called the One Big Beautiful Bill, or BBB. Is anyone on Capitol Hill referring to this as Triple B, or is it just BBB?
So the OBBB is what I've heard so far. No Triple B yet. It would be much easier to call it that for sure. But I haven't seen that yet, unfortunately.
Yeah. Well, I'm going to throw my suggestion out to the folks in Congress and say we should start referring to it as the OBBB.
O Triple B. All right. So I will. I'll start tweeting. Well, I can't tweet President Donald Trump, but I can tweet the rest of Congress and the Ways and Means Committee and all of them to get this moved and have a motion put into this, which will then go to a committee, which will then go to a subcommittee, and then which will then go to So as it goes in Congress.
The most efficient process money can. Yeah. No, but on a more serious note, the main question a lot of my clients have been asking about is bonus depreciation. Is it coming back? What does it look like if it comes back? What rates are it? What is it going back to 100%? When is it going to be effective? How long is it going to be effective for? That's the main thing that my clients are primarily focused on at the moment.
Yeah, it's like this is the one BBB, the one big bonus depreciation bill, right? We leave out the D. But so where we currently stand today is actually, like, I follow this very closely. It seems like the Senate is going to release a text that they are going to vote on. They're going to try and vote on it this weekend. Now, some people are pouring cold water on it. Some people are not. They would love to try and get this done by July 4th. President Trump is very much pushing them to get this finished by July 4th. And where depreciation stands right now is it is going to be 100% bonus depreciation permanently. And that's not like, so I know way back in 2017, we got 100% bonus depreciation that came into effect. And it was basically, it was supposed to be a 4-year scale, which turned into a little bit longer due to COVID, and they got a little bit more extended. And then we've had our falling rates 2023 and beyond. But as of right now, in the Senate's version, it's going to be 100% bonus permanently. There's no cutoff, there's no phase out, no phase down. It stays at 100% bonus basically in perpetuity until someone else comes in and changes the law again and turns the spigot off, basically.
Yeah, it's really interesting. And you probably have more insight into this than I do, but from what I understand, bonus depreciation is a relatively popular piece of tax legislation across the aisle for both Republicans and Democrats. So it's entirely possible that even if the tides of Congress were to shift, that this 100% bonus depreciation, if left in perpetuity, might just remain on and it never really gets shifted back off unless something major shifts. So that's just something to be aware of, I guess.
Totally. So I'll do a tiny bit of history with bonus depreciation since we're on the topic, is that it's actually a new-ish provision for the tax code, right? So 149 expensing has been around since 1958. So it's been around for 75 plus years. Bonus depreciation has just been around for about 20-ish years, a little over 20 years, which makes it a newer provision thinking about how old our tax code is. So it hasn't been around that long, and it's just increasingly gotten bigger and better as time has gone on until obviously got up to 100% in 2017. So now, with it being 100% bonus, which is great because there's no phase-out schedule, there's no going down, it's very popular with economists. Like you mentioned, it's somewhat bipartisan. So I definitely think it's a big win, and I think it's a high unlikelihood that it gets turned off unless someone wants to get creative and they find a way to bring it back to a schedule or something like that. I don't anticipate that to happen, in all honesty. I think it's going to stay. And I feel that this bill feels almost inevitable, in my opinion. It doesn't feel like it's going to stop, even though there's so many issues with it from both sides of the aisle. So I really think permanent 100% bonus is going to be here to stay.
I mean, that's great news for our clients and a lot of people, especially in the real estate space, that are constantly acquiring and developing all this bonus eligible property. So that's a huge win.
Now, one catch and caveat to think about is right now is the kind of cutoff is basically anything that's like both acquired and placed in service after January 19th, 2025. So we're kind of in a weird spot where not entirely, so like if you purchase a property, let's say January 1st, it's going to be unfortunately stuck on the graduated rate schedule, or 40%. And new construction also is going to have some weird stuff too, where when was certificate of occupancy issued, right? That's going to be a big factor, right? They're like, when was that taken care of? And there's also component elections that you can make. So even though construction began before that date, there's a chance that if it's self-constructed property, there are pieces of it that might be able to be eligible for 100%, while pieces of it might not be eligible for 100%, depending on when they're placed in service and work began on them. There's a lot. So there's also like a contract clause right now. Basically says, hey, if you got into contract to purchase property before that date, that's how it was in the last bill too. So that way it would kind of like mess with how you get be eligible for the bonus depreciation there. So it's a big catch and caveat, unfortunately. And as I was reading it, I was trying to look for a way out of that. Fortunately, I couldn't find one.
Yeah, that's just something to be aware of. But it's also worth noting that that date is passed. So especially for people, not necessarily in the development space, but if you've already acquired a property and was already placed in service before January 19th, there's really much you can do about it right now. It's just something to be aware of as you're kind of looking to plan your own personal tax situation for 2025.
And so 179 expensing still likely available for everyone. It's still available for everyone to really use. It's like definitely an option if you're not working in residential property space. And then I guess some other things I want to click on real fast that are relevant. I know carried interest was talked about once upon a time. And that is yet to show up in the bill. And at this point, I don't think it's showing up. So carried interest is not going to get... So I originally thought the 3-year hold period would be the piece that would get adjusted. Granted, still doesn't, that didn't even apply to real estate, actually. It's like per usual carve out for real estate. But even then, like I thought maybe it get moved to 5 years, which in my opinion would have made sense from a policy perspective. But wound up not being the case. So pretty good from that perspective too. So carried interest isn't going to get changed. 179 expensing actually has higher limitations than before, right? So that's raising and going up, which is another big advantage for anyone that's investing into real estate. And then, of course, there's some of the other provisions that are more individual related that are coming out. Oh, one major provision that does apply to syndications, 163J interest expensing. So right now, we live in a EBIT world, earnings before interest and taxes, before we apply our 30% test to our net income. So right now, basically, you have a lower threshold that is you're probably taking less interest deductions than you could before because you're having to subtract depreciation. What this bill does and fixes permanently, no rated schedule of years or any fall off either, it actually erases depreciation and amortization as well. And so that means that it doesn't come back. So it means we're always looking at EBIT, not EBITDA, which is super helpful.
Yeah, no, that's huge news. I actually wasn't aware of that until right now. So that's actually a huge win for a lot of our clients that are kind of dealing with 163J limitations on their interest deductions. Taking out that depreciation component is going to be have a pretty
like it currently exists, right? I believe it expired 2022, 2023 is when that expired, but I believe this will make it permanent going forward. So it's another big one for real estate.
Yeah, perfect. Well, Nathan, I know you're always staying up to date with the changes in the OBBB. You can follow Nathan on LinkedIn and Twitter. He's always talking about the tax bill. So I'm just throwing you a little plug right there.
I appreciate it. Also, go to our website, CPATracker.com, or just Google that, and then you'll find that our bill tracker, and we'll email you updates when this happens. So when there are updates from the bill, our breakdown of it, and even the text if you desire to throw that into ChatGPT and give it a read. All right, everyone. So next week, we'll be talking about built-in gain in real estate. Now, this will probably be a multi-series topic, but we'll talk about 704C, built-in gain, and how this can be advantageous for real estate. So tune in next week when we talk about that. Matt, always a pleasure, and this has been another episode of the Major Real Estate Podcast.